What if everything we thought we knew about China's hyper-competitive industries is about to be turned on its head? It began as economic noise, industry players slashing prices, drowning in losses just to outpace their rivals. But now, it's become a national concern, prompting a radical shift in Chinese policy. Beijing is going all-in on its new strategy, combating involution, or as we'll call it today, hyper-competition run amok. So here's the question. Why is the Chinese government suddenly stepping in to curb competition across key sectors like EVs, delivery, and renewables? And what does that mean for investors in China or around the world? Stick with Epoch Report, because by the end of this video, you'll understand one of the biggest economic pivots of our time. And the sectors that could skyrocket as a result? Could 2025 become the year that sets China's next decade of winners? Or will entrenched problems make this reversal too little too late? Let us know in the comments below. Do you think China's anti-hyper-competition push will stabilize its economy, or just create new winners and losers? Let's break it down. You might have recently heard Chinese officials throwing around a somewhat strange term, anti-involution. It's been mentioned in discussions around food delivery, courier services, even electric vehicles. But for many, especially those outside Asia, this phrase raises more questions than answers. So let's simplify it. Involution refers to a condition where all players in a system work harder, expend more resources, yet end up with the same more, even less output. No one wins. Imagine this. You're at a movie theater. Everyone's seated, enjoying a clear view, and someone stands up to see a bit better. Now, the person behind them also has to stand. Soon, the entire room is on its feet. Everyone's more tired, but the view, no better than before. That's involution. More energy, lower returns. In economics, it's what happens when cutthroat price wars and inefficient overexpansion create a race to the bottom. Productivity doesn't improve, profits vanish, labor is strained. In the end, no one wins. Now let's explore how involution is crippling some of China's most high-potential sectors. China's solar technology has long been a source of pride and a global leader. In theory, it should be a flagship sector for growth. So what went wrong? After strong government endorsements, local governments across the country rushed to launch solar projects. With eager capital and subsidies flooding in, the market became overcrowded. Fierce competition led to staggeringly low prices, so low, in fact, that many producers were selling below cost, incurring unsustainable losses. The very companies poised to profit from a green future are now grappling with the fallout of uncontrolled expansion. It's the movie theater all over again. Everyone stood up, but no one's seeing clearer returns. You'd think in a country with booming e-commerce, courier companies would be thriving. But the opposite is unfolding. Major logistics firms began waging pricing wars to gain market share. One player offers steep cuts, the rest follow. Soon, it's down to pennies per package. Delivery drivers facing rain, wind, and heavy workloads are making barely anything per drop-off. It's a textbook case of involution, lots of movement, barely any progress. What should be a profitable high-demand sector has been reduced to exhausting, unprofitable competition. Men, this isn't just a business flaw. It's a national economic problem. The electric vehicle market was supposed to be China's next great industrial ascent. Hundreds of companies have jumped into production. Tesla lowers prices, BYD matches, Peng, Neo, Li Auto, they all slash rates just to keep up. But what happens when everyone lowers prices? Many firms now sell below cost. Imagine vegetable vendors underbidding each other until no one makes a profit. Sure, in the short term, the consumer benefits. But it's a model that no investor or government can sustain. 2023 marked another twist. JD.com dove into China's food delivery arena. Entering a bitter war against giants like Meituan and Ele.me, it launched with zero commission for restaurants, handed out billions in consumer subsidies, poached riders, and flooded the internet with promotion. Meituan fired back with its own subsidies. Ele.me entered late, but matched the firepower. The results? Reckless promotions like free drinks and cash rebates. A consumer might receive a free milk tea and still get paid for ordering it. Beneath the surface, the situation was worsening. Platforms bled cash. Restaurants folded under zero margin pressure. Rider pay plummeted. Service quality dropped. Worst of all, consumer habits shifted toward expecting constant discounts. feeding long-term downward pressure on prices. It's a value-destroying cycle, and it's why Beijing has decided to intervene. This phenomenon isn't random. It's happening because of how China's political and economic systems work. First, local government incentives. Regional governments compete fiercely for GDP growth, tax revenue, and job numbers. When a new industry is seen as sunrise, every province jumps in with land grants, subsidies, and low-interest financing. The result? Massive overbuild and capacity overflow. Second, capital chasing returns. Once a sector looks hot, investment piles in. Venture capital banks, speculators will jump on board. Founders are rewarded not for making money, but for scaling loss-making operations fast enough to attract more funding. Third, weak market exit mechanisms. In a mature market, inefficient firms get weeded out. In China, state-owned and zombie enterprises often stay afloat thanks to subsidies, protective policies, or bank leniency. These players flood the market and suppress rational pricing. Fourth, global headwinds. China's manufacturing boom has dominated exports for decades, but international backlash, especially tariffs from the US and EU, has throttled demand. Producers stuck with overbuilt factories turn back to domestic markets and slash prices to unload inventory. Put together, these factors reinforce involution and delay market correction. Here's where the rubber meets the road. For everyday consumers, getting deals might sound good. Who wouldn't want zero-delivery milk tea and cheaper cars? But on the macro level, this is devastating. Take China's Consumer Price Index. At the start of 2025, it dipped into negative territory. Several months later, it's still flat. Translation: deflation. That means prices are falling consistently, a signal of weakening economic vitality. Here's a simple analogy. CPI decline is like body temperature dropping below 35 degrees Celsius. That's dangerous. Healthy economies post moderate inflation 2 to 3% annually. Below that, businesses suffer, wages stagnate, and investment dries up. Worse, this sets off a doom loop. Stage 1, fierce price competition. Stage 2, profit margins disappear. Stage 3, cost-cutting via layoffs, lower wages, inferior products. Stage 4, consumer spending weakens further. Stage 5, businesses double down on cuts and the spiral deepens. There's no incentive to be first to stop discounting. Whoever pulls back first likely dies first. If you're still watching, you're not here for superficial talking points. You're here for clarity and strategy. We unpack what most financial outlets gloss over, and timing could make all the difference in your portfolio. So go ahead and click to follow our channel and turn on bell notifications. You won't want to miss what's coming next. Recognizing the threat, China's central planners have stepped in. Since March 2025, CPI has begun a slow recovery from minus 0.7% to neutral territory by July. But the bounce back remains fragile. The goal: break the cycle. Just like in 2015, after 45 months of negative producer prices in steel, coal, and cement, the government launched successful supply-side reforms. Today's anti-involution push is a version 2.0 of that playbook, and it's focused on emerging sectors. It's not legacy industries. Beijing's strategy aims to break the prisoner's dilemma, where rational business decisions still hurt everyone. Reshape supply-demand, reducing redundant capacity, and restoring equilibrium. Elevate competition from price wars to innovation wars, from sameness to uniqueness. This shift could have a profound impact on investors, but only if you know where to look. Let's talk direct beneficiaries. First, solar tech. Once the policy dust settles, firms that survive this bloodbath, those with low costs, strong IP, and vertical integration, could see both profit margins and stock multiples surge. Next, rare earths. As a strategic asset class, China dominates their supply. Tighter regulation of production and exports, combined with surging demand for EVs and defense applications, sets up a classic supply-demand mismatch. Third, logistics. With regulators pressing for an end to parcel pricing wars, firms with scale and efficiency like SF Express and JD Logistics are lining up for margin recovery. Food delivery platforms are also emerging from the fire. Meituan and me holding duopoly status, are pivoting from subsidies toward sustainability. That means healthier commission rates, improved rider conditions, and steadier profits for investors. Now, let's zoom out. Insurers will likely benefit. If inflation and interest rates inch higher from this transition, investment yields will rise, boosting returns for their portfolios. Healthcare is another standout. Patented drugs are resistant to involution. As China's population ages, demand will only grow. Firms with innovation pipelines and regulatory approval are well positioned. And finally, tech. Innovation has a natural moat. True R&D isn't easily commoditized in a hyper-competitive environment. Key players in semiconductors, AI, and hardware could gain share as the economy cultivates quality over quantity. In a low-rate world, dividend-paying, financially sound companies will start looking like safe havens. Market sentiment may swing toward these undervalued blue chips with durable business models and little exposure to subsidy-dependent sectors. Now isn't the time to chase hype. It's time to strengthen the core of your investment exposure. So how should investors position? Stage your buying. Enter early on policy announcements, add on official implementation, hold during earnings recovery. Target leaders. Market leaders not only survive shakeouts, they dominate after them. Mind the margin of safety. Don't overpay even for winners. Buy with valuation support. Be patient. Trees don't grow overnight. You need time to let policies take effect and sentiment to shift. Of course, this is no risk-free path. Policy execution remains uncertain. Targets are one thing. Enforcement is another. Winners and losers will emerge from each sector. Choose correctly or risk being on the wrong side of reform. Markets are moody. Even strong fundamentals can be overshadowed by weak investor sentiment. Geopolitical volatility. Trade tensions, sanctions, or global slowdowns can always impact execution. Diversify accordingly. This isn't just about short-term stimulus or quick fixes. China is retooling its economic model after 40 years of relying on labor and land cost advantages. Today's pivot toward innovation, sustainable profit, and smarter competition could launch a new economic chapter, one that rewards real differentiation and lasting value. From green energy to EVs, delivery platforms to strategic metals, opportunities abound, but they'll belong to those who understand how policy shapes the playing field. Where do you see the biggest upside? EVs, solar, or rare earths? Tell us in the comments. Your input fuels future episodes. If this video helped you see the road ahead more clearly, don't just hit like, subscribe to Epoch Report and enable notifications. In this market, clarity, speed, and discipline mean everything. Until next time, keep questioning, stay informed, and invest intelligently.